Hello and welcome. Thanks for taking a couple minutes to go over this material with us. I am James Damschroeder. I will be your tour guide. I am the Chief of Financial Engineering at a software company called Gravity Investments and the Chief Investment Officer at an investment management firm called Gravity Capital Partners. All right, let's get started. I'd like to set the table for our discussion by delving into a few areas of the existing investment landscape that we see as problematic and that we have a nice solution towards. And a couple of those issues are that there's really no way to measure or manage diversification right now, and that the typical approaches that are used to help investors get diversification are failing because they go about it the wrong way. And one of those ways that it's failing is because that the portfolios don't include enough sources of diversification into them. And when you end up relying on relatively few correlations to protect your portfolio against major downswings, we see often those correlations that are the most relied on are the first ones to come together. You've all heard about correlations going to one. Well, it's especially true the more commonly that correlation is relied on as a source of diversification. One of the problems with risk is it's always assumed to be totally separate than returns. Well, I don't think that makes much sense to any of us that have really given that issue any thought. As long as you think about risk for what it is, and what it is losing money, and not some statistical property like variance, it becomes pretty easy to see that risk and return are not two-dimensional. And we've all come to really love and rely on the mean variance investment approach, and that gives rise to this pretty graphic called an efficient frontier. And we think of that risk and return 2D, and we're even so naive to think of that as a trade-off where I can get more return by getting more risk. But that couldn't be further from the truth, as risk and return are inherently one-dimensional. And being one-dimensional in two different things, they have to be exact polar opposites. So in the rearview mirror, as we have made or lost money, it becomes blatantly obvious. We've made money, we've got returns, positive returns. We've lost money, we've got risk or negative returns. The real trick comes in looking forward instead of in the rearview mirror. So the rearview mirror, it's obvious. Going forward, it gets complicated. So investors start to estimate risk by numerous methodologies, including some very basic statistical processes like standard deviation or variance, value at risk, number of different flavors on that, and those each have some of their own issues I'm going to get into in the next slide. So as we look to actually define risk as an input to a portfolio optimization model, most of the rest of the world puts that risk definition as sort of the central or focal point of the optimization. That would of course be the variance and mean variance optimization, where really only the mean is just a simple average of the mean return for the assets, and the variance is the real subject of the optimization. So a couple different topics about what that is. So one, there is some issues with mapping variance to risk. So if risk is losing money, then how well does variance do at predicting losing money? So in some cases it's positively correlated. Imagine you're an emotionally reactive investor and you've got a very volatile portfolio. Well, for those investors, they might do the exact wrong things and buy high and sell low. But the same exact asset with a more seasoned professional investor could capitalize on that variance and buy low and sell high. So while it's an interesting statistical property that should be part of analysis, is it really what risk is? So what we see as being more indicative of risk is of course losing money. In the markets, though, when these black swan type of events kind of come together, and we see that many different assets are all going down together. Well, that's kind of an element of risk that pretty much all investors have to bear. And those types of events are called black swan events. They're incredibly hard to measure or predict with really any kind of standard criteria, and that makes another issue in trying to map some statistical estimation of risk. We believe this is all grounds to put diversification as the focal point of any portfolio optimization. Part of the issue with risk, especially risk management by as measured by a variance, is just the inaccuracy of it, and that inaccuracy really when we need it the most. For example, let's look at this blue line here, beginning with a daily move in excess of 4.5%. So based on measuring risk as variance, which then fits it into these what's called standard distributions. And these are the bell curve distributions. That bell curve predicts that we would only experience a move of over 4.5% 2 days out of about a century here of observations from 1916 to 2010. But what we actually experienced was 194 of such events. So it was wrong by about 100 times order. So the bigger the move, the more it's going to be wrong. And the bigger the move, whether it's plus or minus, obviously a big move minus is losing money, and that's what risk is. So variance is really failing out on those tails or those black swans when we most need to rely on it. So part of the reason why these risk values really fail is due to these black swan events. And black swan events are kind of a neat way to think about risk, because there's tend to have a nice story kind of caught up into it, a theme, a common thread that weaves that story. And just over the last 20 or 30 years, we've seen quite a few of them. They seem to pop up every couple of years, and each one's going to be kind of unique in who it what asset classes and instruments it picks on the most. But they do tend to have this contagion effect where correlations come together and diversification becomes less effective. Now, there's ways to improve upon that, and there's ways that other investors really magnify the impact of this, and we'll help you sort out how to make the most of these types of events. And the hint is the key to optimizing that is by getting better depth of diversification across more types of investments. So more of those types of investments are more likely to hold up, as more of the dominoes start to fall. This slide is really a summary about the contrasting approaches of risk management and diversification management, and we really see that risk management, certainly as it's applied to asset allocation, is really a fool's paradigm. Again, they're trying to measure a black hole, and by the time you succeed in measuring it, you found yourself well inside of it, and it's way too late. And then there's problems about the mapping process. What is risk? What statistical representation of risk is the most accurate? And there's a big error introduced, which isn't really discussed in most academic sense, that this error even exists. Risk is not volatility. Risk is not anything but losing money, and you can't predict that until it happens. And that's just the nature of risk and return being one-dimensional and not two-dimensional. We also see a lot of evidence that suggests that diversification metrics are more stable than risk metrics. And we would then argue that stability is a material asset. I mean, essentially stability is something that's more knowable. So we'd like to build as much attributes into any portfolio as we can that are knowable. That's just another way of taking the risk out of it. So by focusing on diversification instead of, say, volatility, we're emphasizing things that are generally going to be more knowable, and therefore should have a more reliable or robust performing model that conforms to expectations. Diversification used to be easy. Models produced by G-Sphere tend to look a bit like an endowment model, and Harvard's endowment is one of the biggest and one of the best. For those of you that have read one of Swenson's books, it's basically the same type of approach, and they didn't really know they were optimizing for diversification, but their portfolios basically ended up looking a lot like that. So it's an interesting data point to kind of track how those different models have changed over the years. Point in fact, to see how easy it used to be, look at Harvard's endowment's asset allocation in 1982. All right, 2/3 stocks, 1/3 bond. Okay, job's done, and worked great for the university. But as the years has gone by, markets not just have increased in volatility, but also in these giant ups and downs, which volatility doesn't really do a good job of capturing. And in fact, it's a lot worse than just being more volatile, because it's less predictable. It's actually unpredictable volatility. And as this came more and more prominent into the market, you can see how these allocations have shifted. Here, so 66% stock, and now between U.S. and international, we're 48%. Now we're down to 30%, circa 2004. Now we're at 33% into 2010. So they're needing to diversify more and more away from stocks. With the hardest thing to diversify out of is the stock market, and the closest thing to that is like the S&P 500, which is it's S&P 500 is typically the worst thing you can invest in from a diversification perspective. You think it owns 500 things, it's greatly diversified. Well, no. It's adding concentration risk to the one thing that you can't diversify out of the most, which is systemic risk. So by introducing these other sources, more alternatives, more real assets, private equity, bonds, there's more sources of diversification that are more likely to stand up during those black swan type of crisis events. The importance of diversification really is channeled through risk. And again, risk, when I say the word risk, I don't mean volatility. When I say volatility, I mean volatility. When I say risk, I mean risk. And risk here is losing money. So if we lose 10%, it takes an 11% return to get back to even. If we lose 50%, I need a 100% return to get back to even. That offsetting 50% return to lose 50% and then make 50%, that's going to leave me at 75% of my initial investment, down 25% from where I started. And you can see the worse the loss, the greater the return necessary to protect your money and get back to even. So, those black swan events that take things down and are more than just kind of a stationary volatility blip in the market that we see all the time day to day, but true bear markets that are chewing up capital. Those, it's incredibly important to protect against those, so you have more money left to participate in the next upward compounding cycle, whether it lasts 1 or 2 days or 1 or 2 years. As we look at cutting up the landscape from a product perspective, we can see that so much of the investment landscape is different shades of the same gray, and that gray is really the stock market risk, which is far and away the hardest thing to diversify out of, and certainly a very large risk to most any portfolio. One that's so prevalent that a lot of investors just sort of take its presence for granted, but in truth, you can decide how much of it to take, and our technologies will help ferret that out. Our process, called true diversification, is really based on diversifying the diversifiers and including more sources of diversification into that portfolio. I'll show you more in just a second. So you could have diversification, optimization, visualization, measurement, but without good investments to help you get the diversification, it's going to be less than it could be. So what we see is typically a lot of these new sources of diversification tend to be wrapped in less traditional investments, and that should make sense, because the more an investment becomes more mainstream, the more it kind of gets sucked into that current and correlate with one another. So there's always going to be some more better sources of diversification around the fringes, and sometimes that's involved in a manager's active strategy, like long short investing or arbitrage or more tactical investing. Sometimes it just comes from areas of the market that are less efficient, like emerging market debt. And you never know for sure, just because someone's, an investment product's inside one of these fields, that's going to be a good diversifier. We're very good at then sort of sorting out the fake diversification from the real diversification. But by integrating additional sources of potential diversification and then putting that through the optimization process, you're really increasing your chances of ending up with an investment product at the end that's going to offer a fiduciarily strong level of total diversification. So when we look at diversification optimization as really a next generation technology, comparing some of the contrasting elements of the paradigm, really we have risk, and its definition is quite different. Where in true diversification, risk is really free to be estimated in whatever manner the manager best deems that it could possibly map to really the probability of losing capital, and really frees it from this volatility where it's kind of been stuck for the last couple decades. And we're optimizing explicitly for diversification instead of having diversification as sort of a stepchild to that risk minimization. And that's done in a multi-dimensional sense instead of in a two-dimensional sense. And incorporating multiple dimensions gives us additional dimensions or sources of diversification, which really exposes portfolios that have limited sourcing of diversification and likely overexposure to systematic risks, even though there might be a nice diversification benefit. And you could have pretty poorly diversified portfolios that can masquerade as a successful portfolio in mean variance optimization, and those portfolios really get exposed for what they are, looking at it through G-sphere and true diversification. So it's that depth of diversification and that deeper diversification intelligence that G-sphere is really emphasizing, leveraging to create better portfolios. This slide teaches us about the contraction of diversification compared to any contraction of risk, and specifically during a few market crises. It was measured against 4 market crises for these 4 portfolios, and you can see the average at the bottom. But those 4 portfolios were measured against 9/11, the tech collapse, the mortgage meltdown in 2008, and then the Asian currency crisis in 1997. And what we see here for each of the values for risk is measured by a standard deviation. You can see the level of expansion of the risk statistics for a 3-month period during the throes of the crisis against a control period measured before the crisis. And you can see pretty substantial expansions of standard deviation. On average, they're 44% expansion in the standard deviation. We contrast that now, if you will, to the statistics measuring the IPC, or systematic diversification scores, measured for the same period in the same methodology for the same model portfolios. And we see some actually expanded, others contracted, but on average we see a small minor contraction in the diversification, just on the order of 1%. So even through the pretty volatile periods, and a 3 month was sort of designed to be a punitive time period, capturing kind of the worst of them, and diversification was more or less unchanged against a pretty wild jump in risk. So again, by centering the process on those variables that are going to be the most reliable, it's going to lead to better forecasts, more accuracy in your model to conform to that which you modeled it to do. Another interesting way of dicing this data set, we took the range of portfolios. It was the 90 some or 100 and so portfolios that were measured in this research paper, How True Diversification Preserves Capital. And we segmented those portfolios into quartiles, best to worst, based on their diversification scores as measured by the IPC. And then we looked at those IPCs and then how well those IPCs held up by quartile. And the results here were pretty interesting. We can see the worst quartile, so the least diversified portfolios, still actually managed the most contraction during the market crises. The best diversified portfolios in that quartile actually expanded its diversification. So this is a collaborating statement as to the efficacy of depth of diversification. The more diversification one had, the more that diversification tended to hold up, when one needed it. So, looking at diversification from a modern portfolio theory view, um, and I'm going to talk about mean variance optimization specifically here. Now, mean variance optimization was a great step towards getting diversification, and Markowitz told me that there's probably about $1.5 trillion now of dollars across the world, out of about 100 trillion that's wealth management money that's being optimized, and there's a benefit to this optimization, that you get some benefit of diversification. The thing is, all of that diversification benefit gets channeled through this bottleneck called volatility. And mean variance optimization. All right, let's just drill into that. This means mean return, and variance. So essentially we're trying to maximize the numerator, the mean return, minimize the denominator, the variance of returns, or the standard deviation of those returns. So we're trying to maximize our risk-adjusted return ratio. Now, to do this, necessarily we must be favoring assets that have lower volatility. So, okay, that's fine. It gives us these steady assets, but maybe it's not fine. So, some of the best performing assets over most any period are also going to be our most volatile assets, and we also see that there tends to be they tend to be even more volatile than they are positive returning, and that only works within a certain asset class, but tends to hold true. So mean variance optimization then uses diversification to achieve further variance reduction above and beyond, essentially like a weighted average of its own volatilities. That's the diversification benefit that Markowitz gave to the world. The thing is, we're again channeling all this diversification through this variance minimization bottleneck. Let's just destroy that bottleneck, pursue a direct path to diversification, and then maybe volatility, which here is being penalized, could be our asset, to allow assets to bounce around, to give us opportunity to buy and sell and generate profits from them. But so if mean variance optimization is penalizing low volatility to begin with, our diversification is inherently going to be limited, because of that relationship. So we feel that you've got plenty of opportunities to minimize risk in a portfolio, through security selection, through monitoring, through positional trading, stop losses, etc. And you only got one chance for diversification. So you need to take your chance at your asset allocation stage to maximize your diversification, and that's going to have even more of a benefit than trying to do something like minimize volatility. Chances are. So volatility, and its relationship with diversification, in the absence of rebalancing or account activity, is just dilutive. So if you got a bond fund here, or bond fund in blue and a stock fund in the red, and you've got theoretically perfectly balanced portfolio of the two, 50-50, well, your 50-50 portfolio is just going to be right down the middle and split the difference. But it's actually possible, with some volatility and some rebalancing and trading in there to do even better than this red line, and use that rebalancing as a profit ratchet combined with the volatility of the individual assets and protected by the diversification of the whole. And I don't mean to be really picking on mean variance optimization. I think it was a substantial advance, and Markowitz always been quite a gentleman. But the truth is it doesn't work near as well as alternatives do, and this is sort of the proof to that. Here we have what's called an ex ante, or expected efficient frontier. So ex ante just means before you bet, right? So you bet, and then you let your bets play out in the marketplace, and then you look at your results. They're called ex post. And what we see here is generally portfolios should conform towards this efficient frontier. And this is a sign we've got rational investment, participants in the market that are, trying to maximize their returns and minimize what they think is risk, as measured by a volatility, probably because they don't know how to do it any better. But you can see that there is certainly a clustering towards that efficient line, and you can't get beyond it, because that's the frontier in this case of expected returns. So again, this is expected. This is what it's supposed to look. Here's what it actually looks like. This is a graph of 1,000 different investors and their portfolios, all of which had access to portfolio optimization tools. We can't say for sure they used them or not, but that's what they were there for. But we see that instead of having that nice sort of curved shape to it, they kind of are scattered. And if we ran a regression line through here, that regression line is going to have a pretty flat slope to it. Well, what's the consequences of that flat slope? That flat slope means that irrespective of what level of risk we have, all right, it's not teaching us anything about the returns. So that's saying that in the real world, we're not seeing any risk-return relationship here, which is completely against what was expected. At the two, side by side, we clearly see what's happening in the real world, on the right, isn't conforming to what the expectation was. So why is that? Well, we went ahead and took a step to examine the relationship between diversification and returns and contrast that to a risk-return relationship. And I think this is pretty telling. On the right-hand side, on the left-hand side, we see a relationship between standard deviation and returns. And we graphed, I believe this was right about 100 assets. And we graphed those assets 3 different times. So there's 100 green dots, 100 yellow dots, 100 black dots, each representing the same portfolio in 3 different states. The black dots show that portfolio during a bull market. The green dots show that same portfolio during the bear market, 2007 through 9. And then the orange dots are showing the portfolio through a full market cycle. And sure enough, in the bull market, there's a strong positive relationship between risk and return in a bull market. So, hey, if it's a bull market, take more risk, get more return. That's true. Now look what happens in the bear market. Take more risk, lose more money. Okay. And when we combine, across looking at a full market cycle, we've got again this flat least squares line, flat regression line, showing that there's no risk-return relationship there to be had. So again, we see people focusing on the wrong thing. They're focusing on these risk values instead of focusing on diversification. So let's look at diversification. All right, we've got here our red dots are showing the diversification return relationship. Now this is systematic diversification. This is measured by the intra-portfolio correlation. Same research piece, same time, and yes, the same portfolios, but just evaluating them differently. So measuring these portfolios on the basis of their IPC scores, or their systematic diversification scores. I know I use systematic and systemic interchangeably. Some would probably nitpick about that, but we'll get over it. In any case, we see there's no real relationship between returns and diversification. You could have worse diversification, you have better diversification. It's really not really teaching us much or predicting much about returns. Now, those red dots were graphed during a bull market. The blue dots show the relationship between diversification and returns in a bear market. And now we've got a nice consistent linear relationship where the more diversification we have, the less money we lost in that bear market. So if it's not costing us anything to have diversification in the bull market, but yet it's protecting our money in a bear market, well, why would anybody willingly and knowingly accept a lesser diversified portfolio? Now, if you ask me, that's what the quintessential definition of free lunch is all about. So we're able to protect more on the downside. It doesn't cost us anything to do it. Seems like a no-brainer.